Hello and welcome. Today, we're going to talk about the different types of trade finance and how they can help your business grow and expand internationally. Types of trade finance. Hello and welcome. Today, we're going to talk about the different types of trade finance and how they can help your business grow and expand internationally. Trade finance is essential for businesses that operate in the global marketplace. Let's explore some of the most popular trade finance options that are available. What are the main types of trade finance? Trade finance is an umbrella term for international trade finance. In this article, we'll briefly outline some of the main trade finance products available to businesses. Trade credit. This is generally the cheapest and simplest type of payment. This means that sellers can fulfill their product or service obligations with the understanding that customers will pay them 30, 60, or 90 days later. More risk-averse businesses often take out insurance to protect themselves against potential non-payment. Cash advance. This is an unguaranteed payment of funds given to the exporting company prior to delivery of the goods or services. It is popular with exporters because it allows them to start manufacturing their products as soon as they receive an order. However, it can be a high-risk approach for buyers, as production may be delayed and the order may never be fulfilled. Purchase order, PO, financing. Once a customer provides a purchase order, PO, a financier can pay the supplier in advance for delivery of the goods or services. At the agreed later date, the supplier will either reimburse the financier itself or instruct the end customer to make payment directly to the financier. The exact approach used will depend on the structure of the facility, and the amount of finance the financier pays will depend on the strength of the purchase order in question. The objective of a purchase order financing facility is for the lender to provide the necessary finance for the entire trade cycle. Discounting accounts receivable. Companies may also sell invoices, post-dated checks, or bills of exchange to a bank or financial institution at a rate below true value, in exchange for immediate payment. While this can potentially help solve urgent cash flow problems, the discount rate can be relatively high and is calculated based on the risk of default, the creditworthiness of the seller or buyer, and whether the transaction is international or domestic. Term loans. Long-term debt, such as term loans and overdrafts, are more sustainable sources of finance because they are often secured by securities or collateral. However, securing assets owned by companies abroad can be more difficult, mainly due to regional regulations and ownership requirements. Export finance. Export finance is essentially a loan, where the exported goods are the primary form of security or collateral. Lenders will often finance up to 80% of the total value of the assets, but this varies depending on the risks involved. Export credit agencies such as UKEF typically provide this type of finance, and the amount they are willing to lend varies depending on demand, tenor, country risk, and other factors. Other types of business finance. While there are other types of finance, they do not necessarily fall under the umbrella of trade finance. However, SMEs should ensure they have a broad understanding of what is available. Equity finance. This includes tools such as seed funding, angel investment and venture capital, VC, finance. While the precise nature of each varies, the basic principles are the same. Typically, a business owner looking to raise funds will offer a percentage of their shares in exchange for the investment. Then, if the business grows and the shares become more valuable, the investor sells their shares and gets a return on their initial capital. As it can be quite a complicated type of finance, with many different types, we've put together this more extensive guide to capital finance. Leasing and asset-backed finance. Leasing and asset-backed finance involve borrowing funds against assets such as machinery, vehicles, and equipment. There are a number of financing mechanisms available to provide SMEs with access to assets that are repaid in smaller, contractual, tax-deductible repayments. Asset finance. There are also mechanisms that allow SMEs to access equipment, machinery, or other assets. This can be done in exchange for smaller, contractual, tax-deductible repayments over an agreed period of time. There are different types of asset finance, including finance leases, capital leases and operating leases. So, which of these types of commercial finance sounds right for your business? If you'd like to learn more, be sure to check out our other videos and guides on commercial finance. If you enjoyed this video, please share, like and comment to help more people find out more about this video. Thanks for watching and see you next time.